So on that note, we're shifting now to the next panel discussion, which is talking through the implications and complications of the pandemic regarding insurance programs generally, and specifically insurance programs for those board of directors, for officers in the company, and for employment practices liability, to try and mitigate some of the risks that Monica, Siobhan, and Nelson all described. So for that, we'll turn to the moderator, Katie Pfeiffer. Katie is of counsel in Dorsey's Minneapolis office, where she specializes in the area of insurance coverage and, analysis and disputes. I've worked with Katie in the past on such matters, and it's been terrific to get her guidance in the area of how policies are written and how the employer or company can obtain coverage or get good arguments in regards to coverage. So, Katie, thank you so much, and she'll be introducing two exceptional speakers from the Marsh firm. And take it away, Katie.
Morning, everyone. I hope everybody is having a great morning thus far. As Mike said, we're going to be talking about insurance coverage arising out of the pandemic. It's been a hot topic, but the focus has been on property insurance, which is insurance to cover a company's own losses because of COVID-19. And it's a topic we should all be aware of. There is a potential, at least in my mind, there's a potential source of coverage for business losses due to COVID-19 under your property policies. But frankly, there's been a lot of CLEs on that. So we wanted to focus on a couple different but equally important policies. As Mike said, the D&O and the EPL coverage lines. And this morning I have the pleasure of moderating this panel with two exceptionally experienced insurance brokers to talk about D&O and E&O coverage. The first is Michelle Sartain. Both Michelle and Kelly are with Marsh. One second, sorry. Michelle is the U.S.-Canada practice leader for Marsh's management, liability, and professions practice. So D&O coverage is right down her alley. She is, in her capacity, she's responsible for growth, retention, innovation, client service, and guiding sales strategy across the United States. She has more than 23 years of experience in insurance brokering and risk consulting with Marsh in a variety of client-facing and leadership roles. Pre-COVID-19, Michelle worked out of the Marsh Global Headquarters in New York, where she began her career in 1997. Kelly, also with Marsh, is the U.S. Employment Practices Liability and Wage and Hour Coverage leader. So again, the EPLI coverage discussion is right down her alley. She's primarily responsible for manuscripting EPL and wage and hour policies, leading policy and insurance new product reviews, and drafting endorsements in order to deliver the best possible coverage afforded by the insurance market. She's also a claims advocate for Marsh's FinPro practice. She specializes in complex coverage and claims issues concerning employment practices, wage and hour, directors and officers, professional liability, cyber crime, and fiduciary liability. And prior to joining Marsh, Kelly was an associate in a D&O insurance practice group for Troutman Sanders. So with that in mind, one second. We'll get started. So what is D&O insurance? I'm going to start with D&O and then we're going to move to EPLI in a bit. Your D&O policies are protecting your directors and officers and frankly employees as well. And the big thing in this pandemic area, they may respond to claims by shareholders or stakeholders in companies that have been adversely affected by the outbreak. For example, allegations that management's acts caused claimants to suffer financial losses. A particular note, though, these policies don't cover bodily injury. So in other words, if somebody contracts COVID-19, claims it happened at your company, this is not the policy that's going to provide coverage. Frankly, you'd want to be looking at your CGL policy, if it's a third party, your workers' comp policy, if it's an employee, but it's not going to be your D&O policy. However, if somebody said, you misled me about how you were responding to COVID-19 and therefore your stock has dropped and I've suffered a loss, arguably that is what would be covered by a D&O policy. Now I say arguably because the exclusion for bodily injury type claims, the language really matters. There's a narrower exclusion that says we're not going to cover claims for bodily injury. And then there's a broader exclusion that says we're not going to cover claims arising out of bodily injury. And we expect insurers, if the second is applicable, to say, well, if your claim is because you made misrepresentations because of COVID-19, that's because of, or that's arising out of, or because of bodily injury. Now, I think there's arguments against that, but I just want you to be aware that that exclusion, which is going to be a big one here, the language really matters. So thus far, there's been more than a dozen securities lawsuits arising out of the COVID-19 landscape. It's not always directly COVID-19, but it's an overlay of it. Those suits, for example, the cruise lines are a target in a number of suits. So are life sciences companies. As one example, Norwegian Cruise Lines is facing a suit alleging its public filings regarding the effect of COVID-19 on its business were false. Similarly, Inovio Pharmaceuticals has been sued, claiming the CEO made false statements about a development of a vaccine for COVID-19. And you know, given the platform we're using for this presentation, Zoom has also been sued related to the surge in the usage of its platform and the things that were going on early during the pandemic. The allegation is that revealed an allegedly undisclosed weakness in its company's security, contrary to the company's alleged representations. All of these types of claims implicate D&O coverage. It doesn't necessarily mean, frankly, that it will be covered at the end of the day fully, but like most policies, there's a defense or a reimbursement provision of the policy, and then there's an indemnification provision. And the defense or reimbursement is often the biggest part of the policy, or the most attractive to clients. And in many instances, insurers will have to be picking up that reimbursement or defense obligation. So with that in mind, I turn it over to Michelle. And Michelle, do you have any insights with the more than a dozen cases filed so far, how the insurers are responding to these claims, both singularly and broader?
Hey, Katie, good morning, and thank you for having me here. You know, like with D&O claims, it's really a little too early to tell. The initial stages are obviously around notification, and then the insurance carriers' claims departments need to review the allegations against the specific policy wordings. So at this point, it's still a little early to have kind of an overview of how the D&O policies are going to respond to the individual allegations. But with that, I figured I'd just start the discussion talking about the D&O market in general. Because while the topic today is about COVID, the D&O market was actually experiencing a uptick in pricing that really started in Q3 of 2019. And so the situation on the ground was really that the D&O market had had about 15 years of softening pricing, while at the same time, especially the last 3 years, the number of securities claims against public companies had increased significantly to over 400 for the last 3 years. During that time, we saw a transition from typical securities claims around, accounting irregularities to something new called event-driven litigation. So situations like the Me Too movement or a cyber breach then had a knock-on effect to D&O litigation. And then at the same time, there was the Sartain decision that basically indicated that a company could be sued in both state and federal court, causing companies to have to fight a battle on two battlefields, if you will, thereby significantly increasing the cost of litigation that was covered by D&O policies. So that was really the backdrop to the D&O market when COVID hit in March of this year. And at that point in time, while, as you mentioned, COVID, isn't likely to come to D&O policies first and foremost, although we have seen the claims that you just went through, the concern really from the insurance community for D&O underwriters is just the impact that COVID was going to have on the financial wherewithal of the companies that are covered by the D&O policy. So while they're obviously closely watching the specifically COVID-related lawsuits, they're also concerned about looking at a company, how they're dealing with COVID, the impact of COVID on their business, and then finally the impact of COVID on their ability to remain a going organization. Next slide, please. Mike, can you transition? Thank you. So when our clients are meeting with underwriters, typically underwriters will supply a number of questions that are quote unquote COVID related. And they tend to focus on the three areas that I have shown here. So again, with changes in SEC reporting, they want to discuss with the organizations what they've done, how have they possibly amended their insider trading policies, and how they're going to be offering corporate guidance. Then secondly, they're going to focus on resilience, right? Does the organization already have an enterprise risk management process in place? Is it cross-departmental? How robust was it? Basically to get a sense as to the health of the underlying enterprise risk management resiliency within the organization. But then as you can see, a large portion of the concern is just over the financial health of the organization. And again, the questions here are actual sample questions, and I wanted to provide these so that people had access to information that could be immediately usable to them. Because really a lot of the concern is around companies going bankrupt. Because honestly, that is, a point in time in a company's history where there's also likely to be an increase in shareholder litigation. Next slide, please, Mike. So to give everybody a sense of what we've been seeing in terms of D&O rate trends, the next 4 slides go kind of deep into both public and private company D&O rate trends. And then I've also broken them out specifically for food and beverage to try and make it a little bit more relevant for this audience. So as you can see from this chart, these are the average quarterly rate trends going back to Q3 of 2018. And you can see, as I mentioned, really in Q3 of 2019, we started to see a pretty significant increase in the cost of directors and officers insurance. So this is specific to public companies. And you'll note that the gray line is the total program increase, while the blue line is actually the pricing for the primary carrier. And the difference here is really that the market decided the discount that they offered to be an excess carrier, which is again to sit above the primary carrier on a program, was really inadequate for the types of claim development that they were seeing on their books. And so they needed to reduce that discount for participating higher up in a D&O program. So as you saw, we saw the pricing start to tick up in Q3 and then Q4. And then you can see it's really escalated in Q1 and Q2 of this year, putting a lot of companies a little bit back on their heels because of the rapid increase that they saw in their D&O pricing. So the next slide breaks it down for our food and beverage clients. And really what we're seeing here is that the food and beverage clients are pretty close to experiencing what the rest of the market is experiencing. So right in Q1, the average increase was approximately 56%. And one of the things I wanted to mention here is that it's not just about pricing increases. We're also seeing a very significant increase in the retention that the companies are paying. And again, the retention is the financial responsibility of the organization prior to the insurance program starting to provide reimbursement. Next slide, please. So this slide actually details the same information, but specific to private companies. So again, these would be private companies that obviously don't have public securities. And as you can see, the rate increases have been lower. However, pretty significant, as you can imagine. These are relatively expensive programs to begin with. Now, you'll note that in this situation, the primary layer is seeing a higher increase than the total program. And that's often explained by the fact that for many private companies, they only buy one layer of D&O insurance. And so the increase on the primary is effectively the total program increase. So again, just giving people a sense that in Q2, clients saw anywhere between an 11 to 15% increase in their D&O pricing. And again, that could be in conjunction with a change in their self-insured retentions. So then this slide is again specific to private companies in the food and beverage industry, where on average, 7% increase, but specifically food and beverage companies saw a lower increase of approximately 7%. So good news there for the private companies that are in the audience. So Katie, that's really the general overview for D&O. Is there anything else you wanted me to touch on?
Yeah, one question I often get, and you talked a little bit about retentions, but what are the retentions you're seeing in the private and public market?
Mm-hmm.
And how are they changing? Are they changing 10%? Are they changing 50%?
Yeah, so really, it definitely depends on the size of your organization. So looking at public companies first, any company between, I would say, $1 billion and $10 billion in market capitalization was probably carrying somewhere between a $1 to $2.5 million retention going into this market. We're seeing many of those who are at 1 go to 2.5. We're seeing many of those that had a $2.5 million retention go to 5. And that, just to be clear, is without seeing a decrease in the premium increase, if you will. Many insurance carriers are basically just saying that the retentions were just too low, and so that's being factored into the effective rate increase. And then, of course, if you have a larger market capitalization, say above 10 billion, you're likely we're already at a 5, and we've seen many of our clients going to 7.5, 10, or some are even going up to 25, because typically D&O claims, they're not frequency claims. They happen very infrequently, and so some of our clients are choosing to take a higher retention because they do believe that they are not likely to see a D&O claim. And when you kind of increase your retention by multiples, you might have an effect of actually reducing the increase that you're seeing, more so than just a 50 to 100% increase in the underlying retention. And then for private companies, again, the range can be pretty broad based upon the size as calculated by revenue. So it's a little hard to narrow down, but most of our private companies probably had retentions between, I would say, 100,000 and 250 to $1 million, again, depending on the size. And we would see most of those, doubling or trebling, again, based upon their underlying circumstances and financial condition.
Okay, thank you. And to piggyback a bit off of what Michelle has said, we've talked about both private and public companies. One thing to keep in mind on D&O policies is the D&O policies for private companies are what I would consider broader. You're going to get more coverage for a private company than a public company. The D&O policy for a public company is going to be there for the big securities cases and the like, but they don't provide as broad a coverage for indemnification as the private companies. Both policies, though, provide a defense or a reimbursement obligation. And frankly, both in the public and the private market, defending against a claim can be an expensive proposition. So the insurers are looking at that as well. I'm going to have, whether it's public or private, the private companies, I believe the return to the insurance companies is less. The premiums aren't as high, but frankly, they're looking at big expenditures in this time of litigation, where it can be big litigation. So that's factoring in, I think, and Michelle, if you have any comments on that, but that's going to be factoring into the insurer's calculation as to what they want to do going forward.
No, that's absolutely right, Katie. And really a lot of the premium increases, even pre-COVID, were just driven by the volume of claims. As I mentioned, the securities claims had almost doubled about 3 years ago. And so it's very expensive. And then again, as I mentioned, especially for companies that went through an IPO, they now basically had almost doubled the bills because they could have cases that were being fought in both state and federal court. So that's a part of the reason why insurance carriers were also looking to increase their retentions, because they felt like they were being brought into claims, as you mentioned, for the reimbursement of defense costs much earlier, and they just couldn't effectively write those coverages profitably under the terms that they had been previously offering.
Yeah, and the takeaway from all of this, I think, is just as other issue-driven litigation, COVID-19 is driving some litigation, and we expect it will be driving more, which will have an effect on your insurance renewals, on going out to market, and we wanted to give you a sense of what is driving that. Similarly, the next slide, Mike. Similarly, under the EPL insurance coverage, to give some overview of that type of coverage, it can be part of the package for a D&O policy. Might be bound with EPLI insurance as well as fiduciary liability insurance. Sometimes crime is there as well. Or it can be a separate policy, separate insurers between D&O and EPL. And frankly, pretty much every company has a D&O policy. Not quite every company has an EPL policy. I think it's a good thing to have, certainly. And most mid to bigger companies are going to have one, but it's not as standardized in the industry that you have one. What it covers is claims against employers made by employees alleging, for example, discrimination. It could be sex, race, disability, those type of claims. Wrongful termination, harassment, other employment-related issues such as failure to promote. Now, in the turbulent employment market that the pandemic has caused, COVID-19 is an overlay on a number of employment claims tendered under EPL policies. They're not complaining about necessarily, hey, I've gotten COVID, but rather my company has downsized. I was let go. They've downsized because of COVID. I was let go. I believe I shouldn't have been let go. That I was discriminated against or harassed, the like. And there's been a number of claims like that. Like D&O policies, though, there is no coverage for bodily injury type claims under an EPL policy. Anywhere that's going to be for employees, you're going to be looking at your workers' comp policy. The EPL is not going to cover, I got COVID and I was damaged. It's going to cover I was let go because of COVID and I was damaged. And the COVID-19, the pandemic situation is providing a perfect storm for these type of cases. As I said, there's legislation and unprecedented public directives that are affecting companies. It's been a hurried time, and we have to make decisions quickly often. This week, the unemployment protections that have been in place, such as the additional $600 a week from the CARES Act, are expiring, hopefully to be renewed, but they're expiring. And the courts have been somewhat limited in their access. They've sometimes suspended currently accepting new filings or suspended timeframes for filing lawsuits. Whether those suspensions are going to hold up or not, it will be a matter of litigation. So it's really a perfect storm for employment type claims arising, being filed, and then turning to the EPL coverage for potential mitigation of the losses that you might seek or you might experience in this time frame. So with that, Kelly, I mean, the economic downturn, it provides the overlay for COVID-19, but we've also had historic aspects of economic downturns. And can you give us some perspective on how that teaches us what we might expect during this time frame?
Sure thing. Thanks, Katie. I'm pleased to be with everyone this morning. If we could move on to the next slide. We just wanted to offer a quick note on past as prologue. The last economic recession or downturn that we experienced beginning in about 2008, there were notable increases in employment practices liability claims activity stemming from the recession, both in terms of uptick in EEOC charge filings, about 21% higher than they had been in the 10 years prior. Wrongful discharge claims increased at a similar rate, and 2008 saw the highest number of age discrimination charge filings with the EEOC. And look, I think all of this is important because of the perfect storm really that COVID-19 has created, where it's a combination of both an economic downturn, crippling in many instances businesses and industries, but overlaid with very significant, serious health and safety considerations in the workplace. And so, I for one hope I am wrong and that the predictions prove inaccurate, but we are already seeing a significant increase in claims activity. And actually, we can talk about the kind of categories of claims that have the potential to be brought, and in many instances have already been asserted on the next slide. There's not a really neat way to do this, but if we look at kind of the underlying allegations or what the categories of claims are from a high level, we can run through some of those. First and foremost, we've got a lot of activity around leave laws, whether it's the FMLA, the Americans with Disabilities Act, and then of course we've got newer legislation that was passed for good reason, but left a lot of questions, I think, about which employers were subject to the Families First Coronavirus Response Act, what the eligibility was for individual employees. And there's been a whole host of activity coming out of either an employer not permitting leave, or I would say more commonly covered under an EPL policy would be what happens when someone comes back from a leave, either whether they took leave because they were ill themselves, or they were in close contact with someone who tested positive, or for something related to childcare, right? Whether their children's school or summer camp or daycare was closed. It's a very prevalent kind of pattern, I would say, in employment law pre-COVID, this notion that when someone takes an extended leave and then they come back, they're demoted or sidelined by their manager, or otherwise, in their view, retaliated against. There's a lot of fodder for that, and those, frankly, are problematic, difficult, expensive claims to defend. So that's one category. Another would be a raft of discrimination claims based on various different protected characteristics or protected classes. So disability discrimination claims are obviously key here, whether that's an allegation that someone contracted COVID or they're presumed positive and they were discriminated against on that basis, COVID being a disability, which, by the way, is a bit of an open question. But putting that to the side, there's a lot of concern around underlying health conditions, which definitively are disabilities, and whether and to what extent the employer has questioned an employee around those underlying disabilities and taken adverse action against them, allegedly in response. right? And then, you know, as Katie noted at the outset of this section, there were necessarily a lot of hurried, I hate to say it, but in some cases, hasty decisions that were made around workforce reduction measures, and continue to be made, although I would say we've had a little bit more time to get our arms around, you know, what the economic impacts are going to look like, and who within the organization may need to be laid off or furloughed. So all of those decisions on top of that, in terms of calling back folks to the workplace, right? We've, and it's obviously, you know, varies geographically, but in certain pockets we've seen, you know, shelter in place and stay-at-home orders lessening, and folks returning to the workplace or the office environment, and who is going to be called back, who's going to be amongst those groups. So a lot of potential, I would say, for age discrimination claims, gender discrimination claims, depending on you know, what the overall workforce looks like and who is most impacted by those workforce reduction measures. Some other, jumping a few bullets down, class claims under a whole variety of workplace statutes, whether that's the WARN Act, which relates to office or plant closings, and a specified period of notice that the employer needs to provide before that closure takes place. Cobra claims, OSHA claims, and then a separate, I'd say a kind of adjunct category or issue related to employment practices liability are wage and hour claims, whether that's under the Fair Labor Standards Act or similar state laws. So a brief side note there, wage and hour claims, violations of the FLSA and the like are typically excluded entirely from employment practices liability policies. There's some limited exceptions to that rule. We can sometimes get defense expense sublimits for that coverage under EPL, but suffice to say there is a whole separate line of insurance that is available to respond to wage and hour claims. The wage and hour marketplace is small, but it's been actively issuing policies and paying claims for coming up on 7 or 8 years now. But those there's a slew of wage and hour claims already in the door. Again, around, you know, closing locations closing and groups of employees alleging that they weren't paid their final wages or their final paycheck. Concerns around off the clock work and remote work, when we've got large swaths of the working public who are doing their job from an unfamiliar location and maybe don't have their time clock and don't have the same kind of guardrails to make sure they're not emailing at 10 o'clock at night and then accruing that time. So lots of exposure there for employers. And then I mentioned retaliation above with respect to the leave claims, but that's one subject that we've seen retaliation claims follow on the heels of. Another large category is with respect to allegations that the employer didn't support or ensure a safe workplace, whether that's from being open when you shouldn't be, in violation of a state or local order, not enforcing whatever the relevant and frankly shifting local health and CDC guidance might be with respect to social distancing and personal protective equipment, you know, all of those types of things. You didn't provide us with masks, or, you know, you were not, you said masks were required, but our store is filled with customers not wearing masks. So all of those types of activities can lead to allegations or complaints by the employee, whether that's to OSHA or some other health and safety authority. And then invariably, when that individual is disciplined or there's some negative action taken with respect to them, you can assure yourself that you're going to see a retaliation claim follow on the heels. Remote workforce related, that kind of cuts a broad category in terms of both the wage and hour as well as the kind of loosening of formalities, I would say, that we see now that we're all, you know, not all of us, but in some instances working in our pajamas with kids in the background, having Zoom happy hours. So a real concern around that. But to jump to the next slide, and I'm mindful of time, there are a few other issues I wanted to cover. And frankly, this slide around coverage issues is one we could spend an entire hour on easily, but just wanted to point out a few of the considerations that we have and coverage issues that are coming up in the claims that we, Marsh, have noticed on behalf of our clients. I'll say we track very closely all of our what we'll call COVID-19 related claims. Our claims reporting system has a nice, easy way to tag a claim so we can see at a glance how many D&O COVID claims do we have, how many EPL, how many crime, how many fiduciary. I will say EPL, unlike D&O policy where we've got a handful of certainly securities class actions that Michelle noted at the outset, but we're not really expecting the D&O policies to bear the brunt of COVID-19 litigation by and large. Conversely, EPL policies, we are, and the EPL market is as well. It's a high frequency, traditionally low severity, kind of the inverse of a D&O claim or a D&O policy, but we've seen a lot of significant claims settlements in recent days. So what does that mean? It means carriers are, not surprisingly, taking a very hard look at some of these coverage issues, and I hate to say it, but disclaiming them where they can. Just a few categories to point out. One is, the home, if there is one under any of these lines of coverage for some of these leave law violations, on their face, most EPL policies will say, well, this policy covers damages and settlements and all of these various other things, but not benefits or wages or some other item or entitlement that you have already promised to your employee, right? Like there's not a mechanism to transfer the cost of that to the insurance market. So to the extent the allegation is I was entitled to leave and you didn't give it to me, certainly bears reporting to an EPL policy, but unless there's a follow-on discrimination or retaliation claim, it's not likely to trigger coverage. On the other hand, I've got here, or any other protected class, these policies are intended to cover claims of discrimination, regardless of the basis on which the individual employee alleges that they were discriminated against. So we start from, the premise of Title VII and the protected classes that are outlined there, but obviously in many instances, California and others, state law can be much broader, much more favorable to plaintiffs, to employees. And so we've seen some, I'd say, newer protected classes, particularly coming out of the COVID-19 situation. One is caretaker status. So there's, the allegation is I was discriminated against or treated unfairly because I am a caretaker, either for my children because their schools are closed, for my elderly parents, what have you. The policy should respond if the allegation is discrimination. We would generally speaking expect that to be a triggering wrongful act. A kind of quasi covered in part and not in others is this breach of employment contract notion, where that is also typically called out as a wrongful act covered under employment practices liability policy. The allegation that I had an employment contract and you, employer, breached it in some form or fashion, that will trigger coverage, meaning a defense expense reimbursement obligation, typically on behalf of the insurer. But the contract obligations, whatever it is that that person is alleging they are entitled to under that contract, that's not going to be covered loss by and large. And that's a kind of foundational insurance coverage principle, right? The policies are not there to pick up the obligations that the insured agreed to undertake before there was ever a claim in the first instance. Related to that, we've seen, and this I think we saw a lot of activity around this in the Me Too movement, which, by the way, we're still working through those claims with the EPL markets. But the notion that severance or any amount that an employer has offered at separation or to encourage an employee to separate themselves from employment, get into some, I'll say, interesting conversations with carriers where there's been a severance offer extended and rejected, and then the employee comes back and alleges some parade of horribles around, discrimination or harassment or retaliation and the like. So just be mindful that that can cause coverage issues with the carrier. And then we've got this kind of alphabet soup of workplace statutes where there are often exclusions for OSHA claims, for WARN claims, for FLSA claims, the wage and hour piece that I talked about. But there might be another coverage home for it just because it's not typically covered under EPL. Like I said, with the FLSA claims, we've got wage and hour coverage available. There could be a D&O component to some of these. Certainly, to the extent it involves an employee who is injured at work or by virtue of their employment, you would be looking at workers' comp. Conversely, general liability in the case of third parties, visitors, customers, et cetera. So, I would say consider a wide lens when you're thinking about these coverage issues. There is no harm. I have to put in a plug for timely notice. There's no harm in submitting notice to an insurance policy that does not ultimately respond. We much prefer to kind of blanket all of our possible coverage avenues and get a declination in hand rather than finding out, months or years later that there might have been some coverage had it been timely tendered, because that can be a complete and absolute bar to coverage under many of these lines of coverage. And then finally, Katie's already covered it sufficiently, but the bodily exclusion is going to be in your EPL policy. The question is whether it is a for, which we would much prefer to see, a for bodily injury rather than one of these broader based upon arising out of type exclusions that we try to avoid at all costs. Next slide, we've got a few questions from underwriters. They track in some format the questions that you can see from the D&O underwriters that Michelle laid out at the outset, but they're obviously trying to get at different issues, right? Certainly the impact to the business, the financial viability of the business, you're going to be hearing about that from all of your financial lines underwriters, but the EPL and the wage and hour underwriters are going to dig much deeper into, okay, what has actually happened with your workforce? Have you conducted RIFs? Are you closing any locations? What was your process for deciding who would be subject to these workforce reduction measures? Did you conduct a disparate impact study? Let's hope that you did. Is outside legal counsel involved in reviewing those decisions and assisting you with that process? It's not unheard of for some businesses to be benefiting from COVID-19. So to the extent the company is increasing hiring or expanding business, headcount is one of the key drivers of EPL rates. So the underwriters want to know very, not to a person, but as close in real time as they can, what does your current workforce look like in terms of numbers and by location? Where are they spread throughout the U.S.? And then, lots more questions, I would say, than we've ever seen previously around procedures with respect to compliance with HIPAA, health information. How is the company handling disability and other accommodation requests for employees that might be covered under the ADA? What are you doing about temperature testing? How are you conducting it? How are you ensuring the confidentiality of the employees as they're undergoing that testing? So these are sample questions, but these are real questions that we're getting from the EPL marketplace. And obviously we're always there to help guide our clients and set them up for success, because this can make or break, I would say, the EPL renewal, which if we transition to the next slide, we've just got a few rate data points. You'll see it's similar in its slow creep upwards, but nothing close to the public company D&O rate data, although we did see for Q2 of 2020 rate increases hovering right around 7%. Some of our carrier partners, particularly the Bermuda marketplace that write typically larger employer headcount, larger retention programs, some of them are mandating minimum increases of 10 to 15%. So I suspect, again, I wish it weren't so, but I think we're going to see those rate increases continue to climb as the months go on, as summer winds down, as the CARES Act unemployment benefits dry up. I think we're going to see an increase in claims activity and carriers kind of bracing for the increase in claims payments that they're expecting to make.
Thank you, Kelly. We just have a minute or two left. The last slides are really about, what do you do if you receive a claim, and just very quickly tender it. As Kelly said, it's not going to hurt you to tender it, especially if the policy never actually has to respond to it. These are D&O and EPL are generally claims-made policies, so there is a time frame that you have to comply with. And in many states, if you don't comply with that time frame, you aren't going to be able to get coverage. So it's important to tender it timely. A big question I also often get is, can I pick my own counsel? And that's going to depend on your policy. D&O, depending on the type of claim it is, you may get to pick your own policy. You may have to pick from a panel list that is often attached to the policy. EPL, again, you may get to pick your own. If it's a class action or a mass action, you probably have to pick from a panel, but it's really going to be keyed off the policy. And then you're going to get questions from the insurer, and you need to cooperate with the insurer to give them the information they need. You don't have to cut your own throat, frankly, with giving them information that's damaging to you. But with respect to the claim, you need to give them the information that allows them to make determinations, and especially if they're defending. And then Kelly and Michelle put together, some of the things you want to think about. This is on our last slide for preparing for a renewal. Michelle, Kelly, anything to add to that?
No, I mean, I think that it's just 4 points, but you can't be harmed in any way by starting the process early. And part of that starting early is really just educate yourself on what's happening in the market. As we talked about today, prepare internal stakeholders to participate in the providing information or participating in the underwriting meetings to make sure that the underwriters have a clear understanding of how your organization is managing through the crisis and the impacts that the crisis will have on your business. As we talked about here, you need to understand your priorities. You need to know whether it's the pricing of the program that's most important to you, maintaining the limit that you previously carried, taking an increased retention to trade on pricing, or if you're willing to actually give up some coverage in order to see if you can use that as a mechanism to mitigate pricing. But what I will say is inevitably, nobody gets everything they want in this market. As hard as we all work to try and negotiate the best outcome, it really is very difficult. And so it's working in coordination with your broker to make sure that everybody is clear on what your priorities are. And then finally, just be prepared. As both Kelly and I provided, these are some sample questions, but you should be prepared to be open and honest about how COVID is impacting your business, what you've done to protect yourself from litigation, and expect that underwriters are going to want answers to those questions. And an inability or unwillingness to answer those questions will not be viewed favorably and will generally lead to a worse outcome.
Right.
Kelly, I don't know if there's anything you wanted to add.
Yeah, I'll piggyback on that. As noted, there's a question that came in the chat function. What are some of the best practices companies can engage in to qualify for lower EPL rates? Just as Michelle said, audits by outside counsel certainly are helpful. Anything that you can do as an insured to differentiate yourself from your peers and show how what you are doing is better than is going to go a long way. And we, in this business travel is hard to come by these days. We would often encourage our clients to have face-to-face meetings with their underwriters. In this day and age, I've seen some very successful Zoom calls and conference calls, though, with the insured, kind of, making sure you have the right people as part of that conversation as well. So typically for an EPL renewal, we're looking at someone from HR, someone from legal, someone from risk management, showing how all of the various stakeholders in employment practices liability in the organization, if you will, have a voice in the process, and walking through how you're protecting your employees, how you're shifting the goalposts, as I heard a speaker on the earlier panel say, right? This is a completely iterative process. It requires lots of adjustment and tweaking, and it's not an all fits, it's not a one size fits all approach, even for your own organization, where you might have, spread throughout the country, vastly different infection rates and protocols and processes you need to have in place. So just having a plan and being able to articulate that, I think first and foremost will go a long way in demonstrating to the markets why you're a risk they want to undertake.
So, Katie, this is Mike. Two things real quick. One, a piece of information for those. We had a little bit of warbling on the phone when you read out the code. So it's Q as in Quebec, S as in Samuel, R as in Robert, just so everybody knows. And then second, we got two questions, one from Jim, another from Steve, really both to you, Kelly, and that is different ways of looking at the same question, but this issue of causation in COVID. And first, whether you're seeing states like California actually accepting claims for workers' comp or other benefits. And then second, for other claims relating to employers outside of workers' comp for customers and the like, what do you see the likelihood is of causation proof in those cases?
I think that's the million or perhaps $1 billion question. And I'll be honest, work comp is a bit outside my area of expertise, but I do know that is the rub, right? That is the critical question, is whether or not it was an illness or an injury contracted at work. And that's, potentially very problematic for employees and for plaintiffs. In terms of risk management, what can employers do? It goes back to those thoughtful processes, that iterative process, continually refining how you are handling the situation, how you're adapting. Certainly with respect to your employee base, I say it would go a long way to be proactive and overly communicative with your employees about what your expectations are of them when they're on the work site, what you're doing to keep them safe, and maintaining that kind of paper trail, if you will, of what the relevant guidance was at the time, what actions your organization took in response, because as we all have already seen over the last few months, things can change so quickly. And so if you can point back to, a point in time 6 months ago and say, well, we were doing everything that the CDC and the local health guidance and everyone else advised us to do, there's no bulletproof approach, but I think that's going to put organizations in the best position to defend against these ultimately what are going to be bodily injury claims brought by employees and customers and vendors.
And Mike, this
terrific.
To speak real quickly on workers' comp, it's going to depend a lot upon whether your state has taken the action, such as Minnesota, to say, if a person in Minnesota, it's a person in a particular industry, if they got COVID-19, there's a rebuttable presumption that they got it at work. But for example, in Minnesota, that's only in certain employment, essential type workers, nurses and fire department and police officers. If you're not, at least in Minnesota, the employee is going to have to show it. And that's going to take tracing and, hey, somebody at work was diagnosed with COVID. I got it 7 days after I was at work with him. So it's really going to be a hit or miss, I think, in many states, and it's going to be a heavy burden on the employee.
All right, terrific. Well, thank you to each of the panelists for a great presentation. Katie, for piecing it together, Michelle and Kelly as well. Really terrific information. We're running a little bit late here, but I would like to start on time for the next, and I'll say ish. So we'll take a 5-minute break here and then start the next panel presentation, and that will be really interesting as well. We'll be turning from what's been happening and happened in areas relating to COVID and the agriculture economy, and looking now to the future of food, and specifically the ways that the dynamic industry has expanded and will be expanding as customers demand different types of food-related products. So encourage you to come back in 5 minutes. And we'll be talking about that, and then end with our keynote presentation from Senator Heidi Heitkamp on the pandemic's impact on rural America and the farm economy. So we'll see you in a few minutes.